From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, it's Friday, August 9th, 2019. You're listening to the Hamilton Place Strategies Macrocast. I'm Tony Fratto, coming to you from New York this week, and John Fagan and Brendan Walsh with Markets Policy Partners are in Washington, D.C. at the HPS Podcast Studio. Guys, another wild week as the trade war, and I think, according to the Wall Street Journal, we are now allowed to officially refer it to a trade war. We've been calling it a trade war for a long time, but now it's official because the Wall Street Bible has conferred that. But it's morphing into a currency war. The Chinese allowing its currency, the yuan, the RMB, to fall in value. U.S. Treasury reversed its course from the spring, from when it did not call China a currency manipulator. It comes back and calls it now it is a manipulator. And the president officially tossed the U.S. strong dollar policy out the window, unceremoniously did it with a tweet. But it's very official because all official things happen in tweets these days. And the Chinese last night said, "Oh yeah, you like strong dollar? Well, we're going to change our, not turn the notch on our rate to reset their trading range for the RMB down another notch or two overnight." And yet markets are really right back where we started the week, more or less.
Kind of fascinating. When I was talking on Monday, we'll have a ton of stuff to talk about this week, but I also said, but we can't write it up now because the next 3 days are probably going to be a little bonkers.
Right. And then here we are. It's been, for the week, we're down, right? But it's but overall, it's been pretty. Yeah,
markets
muted.
It's been a real tug of war.
Look, some of this stuff should have a real economy impact. Some should have some financial market impact. Some of it is really symbolic. But how are market participants consuming all of this and reading it? John, I know you were up in New York all day yesterday. I'm sure you talked to a lot of people in the markets.
Absolutely, yeah. I was in New York for the past 3 days, and it really was fascinating. And watching how this played out, obviously last week it kicked it off with the Thursday announcement by President Trump, the new round of tariffs. He had expressed displeasure with the reports that he'd gotten from his delegation that had just come back from Shanghai, and that was the starting gun for this latest round of volatility. But we saw U.S. equities, as with previous escalations by the Trump side, from the U.S. side in this now trade war, I guess we can we can call it that. The markets digested it relatively well.
Trade war.
Yeah, Thursday post, after the announcement, Friday stocks were down. Thursday, Friday stocks were down, but it wasn't a rout by any stretch of the imagination. The S&P 500 was down less than 1%. It didn't have a great week, but the risk aversion really amped up after the Chinese response this past weekend, and that, as you alluded to, they brought the currency into play, and they came out what is Sunday night U.S. time, and came out with a very aggressive weakening of the renminbi. The renminbi has a trading band of 2% on each side of the fixing. That's relatively newly minted. They've ratcheted that wider over the years, and it used almost all of it. It was 1.6% weaker, which is a eye-popping move for the renminbi against the dollar, and that came as the Chinese announced that they were going to be withholding purchases of farm goods in the U.S., which is obviously designed to punch President Trump right in his base, right where it hurts in his political base in the heartland, and it was that was what really kicked off the significant equity market volatility. And I think that speaks to the fact that, we've had U.S. markets particularly have a comfort level with President Trump. They know he's a pressure negotiator. The consensus has been that every escalation that President Trump makes is just a step. It's a means to an end, a step closer to a deal. But when the Chinese hinted that maybe they were, it was time that they were sort of calling his bluff, and that they may walk away from the table. Things really got pretty dicey in financial markets. The S&P was down over 3%. On Monday, and that is and we saw volatility rising across asset classes. We saw Treasury yields plunging. We saw the dollar moving. We saw commodities obviously affected. It was all singing, all dancing.
The 10-year, the 10-year cutting down to below crisis level rates.
Yeah, and so the escalation went on through Monday. After U.S. markets closed on Monday, that was when when the Treasury Department came out with the designation of China as a currency manipulator, and there was this, this audible gasp in the markets when that occurred. And
but what exactly does that mean?
That was, and then oddly enough,
to designate them a currency manipulator. I think people would be interested from the view from a Treasury official. What actually does it mean?
I worked on a bunch of those reports, and and they always felt really important. By the way, the Chinese always took it as very important. It was meaningful to them to not be labeled a manipulator. We would hear this in bilateral meetings, I think, with a lot of sincerity, and they would tell other people that it was meaningful to them, and so it was held out there as sort of a kind of a nuclear option that you would the Treasury would name them a currency manipulator, and then came and gone this week without much real impact. I mean, I'm sure I know the Chinese are not happy about it at all, but the real things of what you can do once you've named someone a manipulator are pretty limited. You have to go negotiate with have meetings with the IMF, and you present your cases, and there's some arbitration that goes on, but there's no trigger to anything. To me, it's sort of like it looked like a baseball fight to me.
Yeah,
right. And that was the reaction.
Throw the helmet and slap punching.
Yeah, kick the dirt.
In some ways, that the shock of the announcement really, markets were obviously U.S. markets were closed. It was after markets, after hours trading, which is always low liquidity and whippy and incomplete. But the initial reaction was a further gut-wrenching shock. But then the immediate commentary that we started getting from market contacts was, hey, look at the statement that came out from Treasury. It says, as a consequence, basically the statement said, as a consequence of this designation, Secretary Mnuchin will engage with the IMF to initiate a process and then traders stop reading.
Yeah. By the way, that's not discretionary. By the way, though,
right?
That's like what Treasury had in its statement was exactly what the statute prescribes to be done. It was very technical language.
That's right, but there's nothing that would have held the White House back from saying, and if they don't reverse this or do something, we might add additional tariffs or something like. They could have certainly done that. And the fact that it kicked off this what all traders assume will be a laborious process with the IMF. The IMF is certainly not eager to stick their finger in China's eye, and so one would assume that.
But also, correct me if I'm wrong.
And I got a lot of those calls. I got a lot of calls from reporters saying, so what happens? And I said, well, look, here's what the statute says. And to your point, John, this is what the statute says. But remember, President has demonstrated multiple times that. He'll do whatever he feels like doing. If he wants to, if he had gotten up the next morning and said, "That's it," what, did I say 25% tariffs? Tariffs are not going to be 30%. There's no one to tell him he can't do that.
Right.
Literally, right? I mean, he can do that, and it starts going into action.
Right, and the fact that he didn't, the designation The designation was a shock, but it almost cleared the air. That was kind of a turning point in the markets. The idea that the Trump administration had initiated the process, but hadn't attached any further, tariff threats or anything like that to it. And then overnight, everybody on Wall Street and in the macro community was all fixated upon where the Chinese were going to place the center of their trading band for the renminbi. Now, just for everybody that's not necessarily following this on a day-to-day basis, the Chinese control their currency very tightly. It is in as I mentioned, a plus or minus 2% band around a daily fixing. The People's Bank of China, the central bank, fixes that daily rate, and it supposedly fixes it on a formula, market-determined formula that they don't necessarily divulge. But there's clearly they always have discretion in Beijing, and so the way that traders look at it on Wall Street is they have their own models which they think are pretty accurate, and they compare the fixing versus their estimates. And the estimates everybody was watching their estimates, everybody collected the consensus estimates, and the Chinese central bank fixed on Monday night, just after that designation, they fixed the renminbi bang on the estimated figure. Right. And there was a huge sigh of relief. Everyone felt as though those two events, the designation, but no tariff threat on the back of it, and then the spot on fixing by the Chinese, indicated a pulling back from the brink. And we saw that narrative play out over the ensuing days. And
I think the algorithms now have added a new risk on or risk off indicator, and it's what that is. If you see a 7 overnight from the Chinese, it means they're mad, so you probably sell. And then the next day, if it's a little lower, time to buy again.
Yeah, the trader. I mean, basically, the investment community is downplaying the fact that the spot rate is trading. The renminbi is trading weaker than 7 to the dollar, which was considered a very important line in the sand. And subsequent fixings have been weaker than that, but they have been, but at least until last evening, they were on the stronger side of estimates. And we saw after the big move on Monday, the renminbi really calmed down.
Though, also correct me if I'm wrong, but for the last 4 to 5 years, the interventions by China have been to stop the renminbi from weakening. They've been keeping it strong, haven't they?
I would go back and check the duration, but certainly the most recent trend has been for the renminbi to be fixed on the stronger side of estimates. And that consistent fixing on the stronger side is taken by traders, and I think rightly so, to show intent. And basically the People's Bank of China kind of leaning against the wind, which are some depreciating pressures on the renminbi, the shrinking current account surplus, right, and weaker growth and so forth. And they've been based on their fixings, they've been holding the line.
Yeah. So if you go to the IMF and if the Chinese say, "Oh, fine, we'll stop intervening, we'll let it float for free," you might get the exact opposite.
And that's what the Chinese officials said after the move. They said, "Well, we let the market determine it. This was a reasonable market-determined rate." And they have a point. The manipulation, they by any rational measure, they are control the currency very tightly. But which direction is it?
Yeah, they are, of course. But I think this is not well understood. When people saw headlines saying, that the Chinese, there was a revaluation in the RMB. Unless you are paying close attention to this, your presumption is that they entered the market, intervened, and actively are weakening. But it's the market pressure definitely is on the downside. There are really good reasons for that, and we have but one of them, by the way, is the trade war itself. The trade war is putting pressure on the RMB to weaken and the dollar to strengthen. So, regardless of what the president says about it, I mean, he says two different things. He says, dollars are flowing into the United States. And that's a good thing. It's a beautiful thing, actually, is what he says. It's a beautiful thing that these dollars are flowing into the United States. And he wants a weaker dollar. And you can't have both of those things. Dollars
that's
flowing
Econ
into the
101.
United States and people bidding up the dollar. You need to buy dollars. But that's not even exactly what's happening either. So,
right.
But look, the Chinese...
We pay for the tariffs, right?
Your theme of stepping back from the brink a little bit. They're not canceling September. There's no evidence that they're coming back, so that's one on the positive.
Yeah, that's been a key. That's been a key bulwark for sentiment in the investment community. The fact that the Chinese have not pulled out of that September delegation to Washington. We don't have a lot of details on the schedule, and there were some state media sources from China that threatened that they might, but that's still as far as everybody knows, and official communication suggests that it's still on, and that is a huge that's a huge support under sentiment. The fact that the two sides are still talking, and we haven't gone into a full-blown knockdown, drag-out trade and currency.
Yeah, it seems that they're signaling that they've got their hands on the wheel, even with the refixing the peg, right? They seem to be signaling they've got their hands on the wheel, and this isn't going to. They don't want this to go out of control. At the same time, to send signals. Now, one other thing, just very quickly before we go to a break, because I do want to. There is one other element to this that we haven't got into is other economies had to follow suit in allowing their currencies to weaken in Asia. To paraphrase a Princess Bride, should never get into a currency war in Asia. All of these countries have to, their context is this relationship with the United States and China, where the Chinese currency is very, very meaningful to them. So we saw some additional countries, make moves to weaken their currency. That is the kind of thing I think that midweek and early week could get people worried if you start seeing a race to the bottom on currency values.
That was exactly the story that Wall Street woke up to on Wednesday morning, this race to the bottom. The Reserve Bank of New Zealand cut 50 basis points when they were expected to do 25 and sounded dovish. The Bank of Thailand cut when they were expected to hold, and India's central bank also did a larger than expected cut. And that, all three in a row, the message was hard to miss. It was, these are central banks that are very concerned about growth. They're very concerned about their currencies, and this may end up being, as you said, the race to the bottom, and it was.
And last night the Royal Bank of Australia, while they did hold, they promised a couple more this year.
And I think that speaks to what. That we've had a pretty fine balance in markets this year. In some way, equity markets and risk assets have been celebrating central bank easing. The prospect for Fed easing and that sort of thing has, widely understood to be supportive of U.S. equities and global equities to a great extent. But there's too much of a good thing, and I think that's when rates are drifting gently lower, when Treasury yields are drifting gently lower, that's quite nice for stocks. But when they're falling down an elevator shaft and it turns into something that's a global trend, and that's much more destabilizing. Volatility went up. In this latest episode, obviously equity volatility went up, but Treasury market volatility went up, currency market volatility went up, oil price volatility went up. We saw credit spreads widening out. So it was, that carried over a little bit into Wednesday until, markets kind of found their footing.
Now would be a good time to remind the listeners to call your bank and refi your mortgage.
It is definitely the time for that. If you can get it, go get it. Let's take a break right there. Actually, we may have some more signs on that too. I want to get back and talk about where we feel, or at least everyone feels pretty certain the Fed is going. You're listening to the Macrocast. We'll be right back.
The South by Southwest panel picker is live this week, and there are some great panels on the list. Check out our favorites on Twitter at HPS Insight and be sure to vote.
Okay, we're back with the HPS Macrocast. John Fagan, Brendan Walsh in Washington, Tony Fratto in New York. So last week, it seems like it was weeks ago. It was just a week ago that FOMC met, cut rates. One of the things that Chairman Powell noted in making that policy rate cut was the uncertainty and actual macro weakness that they're seeing from trade war. On cue, we get escalation of the trade war, and markets, I think, correctly interpreting what the chairman told them and what they're seeing in front of them, are pricing in some more cuts coming our way.
That's right. Yeah, On Wednesday, we thought that the big story over the next days and weeks would be the market digesting Chair Powell's non-committal performance after the first rate cut in I guess over a decade last Wednesday, which was quite a watershed event. And then his messaging and all the effort that people put into parsing his transcript and trying to get the new fix on exactly where odds for the September rate cut would be. Everybody threw them in the trash on Thursday, and as basically trade war risk drowned out every message that Fed Chair Powell had been sending. So after his presser, the futures implied odds of a second rate cut in September at the September FOMC meeting were around like 60%, and they jumped higher after the 10% tariff threat, and now they're at 100%. And the markets have been sort of going between 1 in 3 to 1 in 4 kind of chances of a more aggressive 50 basis point rate cut at this next meeting, with around 75 to 100 basis points of rate cuts priced at cumulative rate cuts, including last week's, through year end.
Well, interesting. I was talking to a number of Fed watchers this week, and the week after the meeting, you kind of get a debrief on what happened at the meeting, and apparently Chairman Powell was fighting for a 50 basis point cut last week.
That's
interesting. Yeah,
that's interesting, and certainly the conspiracy-minded traders on Wall Street, as soon as President Trump came out on Thursday with the renewed threat, the chatter we heard from the trading desks was, "Wow, he really wants a September rate cut. he's willing to threaten the Chinese to get it." Exactly. That's the emblematic of the Fed-centric mindset that pervades Wall Street these days. But it's a really persistent narrative that that the Fed is inclined to cut rates. This will certainly give them the cover to do so and be more aggressive. I'd sort of put my marker down for my guess had been another 25 basis points in September, but even more reluctant than the last, and trying to signal a pause that they may or may not have been able to do. But I'm with the futures market at 100%, and I think the odds of 50 basis point rate cut are, I think those are pretty, 1 in 3, 1 in 4. I think those are pretty about. Yeah, this seems about right.
And we already saw some banks preceded the Fed, some followed the Fed, as we talked about in the last segment. And do you expect other central banks are going to be out there providing support also?
Yeah, the European Central Bank has basically put the marker down for the September meeting, and the only question that was left from the last meeting was, why didn't you just do it now if you're going to signal so clearly? And really, the only question is how chunky a rate cut does Mario Draghi put in? Does he up the quantitative easing, the asset purchase program, in other words, or employs some other extraordinary easing measures before he has to hand the baton off to Christine Lagarde, who will be succeeding him. The Bank of Japan, they have less. That's widely considered by analysts to have less firepower, but they've got the consumption tax hike coming up in October, and this is, the Bank of Japan is not a central bank that likes to be outdone, and so and certainly the Bank of England has the Brexit risk to contend with. October 31st is the day they've got circled on their calendar. They may not get ahead of it necessarily, but they sure may have to do a rearguard action if there's a hard Brexit, which looks increasingly likely. So,
and this week also brought an amazing out of left field speculation that the Germans might actually be loosening the fiscal ropes and borrowing to combat climate change. Did you see that article?
Yeah, I did. I want to get into that a little bit, actually. Just, I mean, Europe in general. There were some other things that happened this week. I mean, certainly, Germany. I think UK reported a negative quarter. Overnight.
They do this 3 months rolling GDP, and it contracted 0.2%. It was the first contraction since over a 3 month period that they had since 2012. And the pound is really it's been round head. Yeah, it's down around 120. and these are multi-year lows, and traders are looking for potentially looking for more.
There's actually a headline that came across right now that Boris is telling government officials to plan for a no-deal Brexit.
Does the plan include buying gold and bottled water,
guns and butter?
And then we also saw Italy this week. I mean, their governing coalition is falling apart. They're calling, Salvini's calling for new elections. We still see stagnant growth on the continent. I mean, there's the environment for Europe is not going to be an engine of growth for a long time.
Yeah, I think that's and certainly the Italian bonds are having a lousy day today as speculation heats up about a general election, and certainly the polling looks as though the populist Liga member of the current governing coalition is in the pole position, and their now coalition partner, soon to be ex-coalition partner, Five Star, is fading fast. That's not something Deputy Prime Minister Salvini, who's the head of Liga, has not been necessarily a favorite of the markets. He's got a lot of ambitious ideas, some of which are not obviously not to the liking of the bureaucrats in Brussels, and he's a confrontational, although he's pulled back from the brink a number of times. And we've actually seen Italian yields, they're selling off dramatically today. The spread is almost 30 basis points wider against Germany, and that spread over Germany is the key barometer, market-based barometer of Italian sovereign creditworthiness, the 10-year spread over Germany. That's up 30 basis points today, but it's off such favorable levels. And Italian stocks are selling off. They're underperforming. They're down, over 2% when I looked earlier today. But again, they're not coming. They've got some cushion here built up, and they're well off. I think the spreads to Germany, the 10-year spreads to Germany, are a whole percentage point off their worst levels from last November. So we're not. It's a bad day, and there's and there's obviously expressions of concern in the markets, but we're not in the red zone in any of these measures right now.
And talking about Germany, John just mentioned to me this morning that now all German yields are negative. The 30-year went negative yesterday.
That was, potentially one of the things that sort of sparked this this move that we've gotten a hint of from the German government. But we can talk about that. We can talk about that some more. I mean, obviously, the global growth. This has been a market that's kind of done a high wire act all year. We've had, I think some hotel in Vegas has a ad campaign that says just the right amount of wrong, and we've had, in global financial markets, we've kind of had just the right amount of wrong. Global growth has been soft enough to get central banks and fiscal authorities more proactive in the easing department, but it hasn't been, falling off the table and necessarily, recessionary to a degree that would scare everybody off. Rates are drifting lower, but they're drifting lower in a low volatility and pleasant way until just this week. And the pressure against China, people have taken that increasingly. People have taken the provocations of the Trump administration as just a negotiating tactic, and until so it seemed as though for risk assets we kind of had just the right amount of wrong.
No, it's a very good point.
This week we had gone over the line into more wrong stuff.
Yeah, but it is a good point, and people say, well, why are rates so low? But the equity market is still fairly close to the highs, and I think it's a somewhat simple explanation that earnings have actually been quite good and kind of justify, within range, these prices. We just kind of made it through the earnings season, and there was a few disappointments, but they were much more unique to the company rather than across-the-board misses.
Right, and the guidance that generally speaking, the guidance from U.S. corporates in their second quarter, talking about second quarter results, and then looking ahead to future quarters, it was maybe a little tepid. I
would say cautious.
Yeah, cautious, a little low visibility, but certainly not disastrous.
Nope.
And it's hard to get it's hard to get prognosticators pointing at the U.S. economy and saying, this is an economy that looks like it's teetering on the brink of recession. You look at the yield curves, however, and that's what it says.
Yeah.
So the 3-month, 10-year yield curve is deeply negative, as deep as it's been since '07, I guess. And the 2s, 10s, which is everybody's got their favorite pet part of the yield curve that they look at, the spread between units. But the 2s, 10s is the kind of the classic, and that's at 10 basis points. That's as flat as it's been in this cycle. Yeah. It's flat as a pancake, and as the yield curve, the 2s, 10s veered toward inversion, that was one of the things that really caught people's attention, particularly midweek, and contributed to some confusion. We've, again, stepped back from the brink. Treasury markets have stepped back from the brink, just like the trade negotiation. The U.S. and China have stepped back from the brink, hence the rebound in the second half of this week. But it's definitely, the Treasury market's not painting a pretty picture.
All right, guys, let's take our last break right here. Come back, see if there's anything left over we're going to learn from earnings, and then let's look ahead to next week. And it's August. It's going to be slow August,
yep,
as we know. So you're listening to Macrocast. We'll be right back.
You're listening to the HPS Macrocast. Every Friday, we take a look at the major economic trends of the week. See more from Hamilton Place Strategies at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back on the Macrocast. So we had winding down of an exciting earnings season. Actually, I thought there was a lot in there, but on these last run, what's catching your eye the most, and then what should we be looking forward to next week?
Yeah, this week was actually kind of these examples is indicative of the entire earnings season. First we had the CSX report week rails, and then everyone kind of freaked out, and then their competitor came out and said everything's fine. This week we had Uber and Lyft, where Uber reported a monstrous miss, and then everyone kind of freaked out. And then we also get Lyft, who's kind of crushing it, and they're exact competitors. So I think that was kind of a microcosm of the entire earnings season. And in the end, basically the stock market is kind of trading flat from the beginning of earnings season. It was good, but nothing to massively drive it higher, but also nothing out there to massively drive it lower.
So really more just some sectoral stories.
Exactly.
And idiosyncratic to the company.
Yeah, like Walt Disney had a miss. It was kind of unique to Disney.
That's part of a big miss, wasn't it?
Yeah, well, everyone, because they had they had 3 really huge movies, so everyone thought it was good. But I guess the Star Wars park is not doing quite well, which is kind of interesting. Kids don't know what Star Wars is, and old people don't go to amusement parks.
They could have used that analysis about 3 years ago. I think you're right, though.
Don't speak ill of the mouse in my presence. Boy, no. Disney is.
No, I went to a water park last week, which was awesome. I made my kids go because I was the one that wanted to go.
Kids should love water parks, even if you have to make them.
Exactly.
Yeah. All right. So data next week.
Kind of a big week. So it starts on Tuesday with the CPI. So obviously the Fed has been using low inflation, as a means for cutting. But the second quarter actually kind of saw a large bounce back at both the CPI and the PCE. Later in the week on Thursday, we get retail sales, which is outside of the jobs number and the inflation number is probably the third most important data point that the market pays attention to. And then we get a lot of industrial production data from China, the U.S., Japan. So that will kind of give the market an indication of how much the trade war is really hurting the manufacturing sector. But also three other. We get the Chinese IP on Wednesday, but then we also get Chinese retail sales and the fixed asset investment, so the amount of investment going into China, which again will be heavily followed by both the market and also the trade negotiators to see how how much pain the trade war is having on the Chinese economy.
Yeah, earlier this week, it was overnight on Thursday. The Chinese July import and export numbers looked relatively good, particularly the export number. And watching how U.S. exports were declining, but exports to ASEAN and the EU were rising to offset that. And Chinese state media crowed about it and said, "Look, you can't crush China with your tariffs, wagging a finger at the U.S." And it was definitely something that helped boost sentiment. It helped boost interest. It helped boost rates off their floor, pulled them off the mat this week. And so there's a lot of focus on. There could be a lot of focus on these growth numbers, depending on the macro backdrop. But people are going to be scrutinizing them.
And then at the end of the week, we get the University of Michigan consumer confidence. So I think that this will actually be a very interesting one, where the trade war is ramped up, and Trump has been much more vociferous about it, to see whether it's affecting the consumer.
Hey guys, while we're on taping this right now, the president is out saying that the China talks for September could be canceled. He had a lot of other things to say, like that the Fed should cut rates by a full percentage point. So there's a lot of news happening as we speak. So we'll have a lot to look forward to, I think, over the weekend and next week, and no shortage of market interest and DC policy interest. So we'll be back with you next Friday.
It's a good time to be doing what we're doing.
Exactly. We'll be back with you next Friday on the Macrocast. Thanks, guys. Bye.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.